As I gaze out over the amber waves of grain blanketing the American heartland, I can't help but feel a sense of disquiet creeping into my soul. This nation, a shining city upon a hill that has beckoned generations of strivers yearning to breathe free, now seems to be drifting, unmoored from its founding ideals of rugged individualism and free enterprise. The very concept of American capitalism, once the envy of the world, has fallen into malaise and disrepute in recent years. The latest polls from the respected Pew Research Center reveal an unsettling trend. Support for capitalism has plummeted across the demographic spectrum, with a particularly precipitous decline among the young. Astonishingly, a majority of Democrats under 30 now view socialism more favorably than capitalism. This is nothing short of an ideological upheaval, one that would have been unfathomable just a few decades ago. How did we arrive at this juncture of souring disillusionment with the market economics that built the arsenal of democracy and powered the greatest economic engine in human history? The common narrative portrays the Reagan Revolution of the 1980s as the inflection point, when a neoliberal counter-revolution against the post-war welfare state was launched. Historians depict those bygone years after World War II as a golden era of social democracy, when an enlightened alliance of government, business, and labor allocated the fruits of prosperity in a judicious, equitable manner. In this telling, Ronald Reagan and Margaret Thatcher spearheaded a reactionary retrenchment, replacing the proactive hand of an ambitious government with laissez-faire financial deregulation and indiscriminate tax cutting. Their small government ethos disrupted the previous economic order, sowing the seeds of today's rampant inequality and wage stagnation. So goes the prevailing myth. But this simplistic fable crumbles under closer inspection. The reality is that the era of small government was always more fiction than fact. Far from receding, the state's imprint on economic life has only expanded over the past century, transcending the ideological pendulum swings of partisan politics. The numbers don't lie. Government spending in the United States has ballooned eightfold since 1930 as a share of GDP, from under 4% to nearly 25% at the federal level alone. Include state and local expenditures, and the public sector now accounts for over a third of economic output. This growth trajectory has been relentless, with only a brief respite under Bill Clinton before the upward march resumed. What did change under Reagan was the source of funding for this metastasizing bureaucracy. As outlay soared while tax receipts remained stable, the gluttonous state began feasting on a steady diet of debt to sustain its gluttony. Routine budget deficits became the new normal, and the national debt quadrupled as a share of GDP over the ensuing decades. But this buildup of liabilities did not portend a scaling back of government's reach, as proponents of limited government had envisioned. Quite the contrary, it birthed a codependency in which public and private sectors grew inexorably more intertwined. By the 1980s, policymakers had grown haunted by the specter of another Great Depression, terrified that towering debts could ignite a chain reaction of insolvencies. Rather than paring back, they opted instead for a radical new doctrine, the socialization of risk. The Federal Reserve and Treasury Department transformed into a crisis mitigation tag team, vigilantly monitoring markets for any tremors that could escalate into systemic shocks. At the mere intimation of turbulence, the new bailout platoon would spring into action with liquidity injections and corporate rescues to insulate the privileged economic elite from the consequences of their excessive risk-taking. Over time, this extraordinarily uncapitalistic exercise in moral hazard mutated into an all-encompassing economic security blanket that sheltered not just the rich, but all socioeconomic strata from the creative destruction typically associated with free markets. Faced with even mild discomfort, the government impulse became to throw copious amounts of borrowed money at any rustle of financial instability, whether for Wall Street firms or Main Street households. To progressives appalled by this socialism for the rich, I would respond, what we are witnessing is worse. It is socialized risk, a pernicious system that obliterates the distinction between deserving and undeserving, winners and losers. It perverts capitalism into a grotesque caricature of itself, decoupled from any relationship between merit and reward. America has unwittingly become the most complete welfare state in the industrialized world, adrift in a dugout canoe of debt without any paddles for controlling its ideological drift. Economic freedom has corroded as the regulatory thicket has grown denser and debt loads have compounded. By the Heritage Foundation's respected index, the United States has plunged from 4th to 25th globally in economic liberty over the past 2 decades. It would be one thing if this steady encroachment of government had delivered prosperity and broad-based economic revival. But the dismal reality is just the opposite. Thanks to debt-distorted markets and bureaucratic meddling, growth has slowed to a crawl unbecoming of history's most vibrant entrepreneurial culture. The roots of the slowdown trace back to the turn of the millennium when easy money policies went into overdrive. Short-term interest rates were slashed to sedative levels and kept there for years on end. In tandem, the Federal Reserve initiated a barrage of unconventional bond buying programs that pumped vast new reserves into the financial system. This tsunami of liquidity was intended as an emergency salve for the excesses and irrational exuberances that triggered the 2008 financial panic. But what commenced as an all-hands-on-deck crisis response calcified into a permanent new policy regime. Ever larger injections of monetary adrenaline became necessary just to stimulate anemic economic outputs, resembling a premature heart attack victim on life support. Inevitably, the business cycle has degenerated into a flatline, with the wild swings of yesteryear muted into minute fluctuations more befitting a moribund developing economy than the world's premier commercial juggernaut. Where double-digit slumps were once followed by vigorous expansions, the recoveries of the 21st century have downshifted into a purgatory of secularly stagnant growth persistently mired below the 3% benchmark that was once considered unspectacular. The easy money experiment has inflicted debilitating opportunity costs. By papering over the natural ebbs and flows of the capitalist cycle, artificially low interest rates have subsidized the perpetuation of zombies, firms that perennially consume more economic resources than they generate. Free from the discipline of periodic stressors that cull the weak from the herd, zombie companies sap vitality from their healthier competitors by bidding up factor costs like real estate and skilled labor while barely covering their interest expenses. Conservative estimates suggest 1 in 5 publicly traded companies in America now meets the zombie criteria. Where inefficiency and economic deadweight were once pruned away by the shears of creative destruction, in today's subsidized stay of execution the living dead stalk the earth in perpetuity. Progress is obstructed by market-dominating oligopolies that reinforce their incumbencies with calculated lobbying rather than reinvented competitive advantages. It is a grim irony that American-style corporate capitalism, once a lodestar of vibrancy and disruption, has hardened into a cronyist racket reinforcing sclerosis and privilege. This creeping paralysis has smothered the engine of productivity growth that propelled the nation's rise from a rural backwater to an unrivaled economic superpower. Economists have identified a precipitous slide in output per worker stretching back decades as the principal culprit behind anemic GDP gains. Explanations abound, from suboptimal human capital investment to outsourced industrialization. But one factor indisputably looms largest: the dead weight of excessive regulation and debt overhang suffocating animal spirits. So while policymakers deride capitalism as a quasi-socialist system rigged to favor wealth over workers, the greater indictment is that they themselves have engineered an economic anti-reality utterly incongruous with the first principles of dynamic risk-taking that established America's commercial preeminence. The public-private partnership of easy money and corporate bailoutism has necrosed the once robust circulatory system of Joseph Schump. The great paradox is that the very policies aimed at insulating the economy from disruption have proven most disruptive of all. By arrogating to itself the power to dictate winners and losers, the government has destabilized the foundations of fair competition upon which healthy capitalism depends. No longer is merit rewarded through the churning forces of creative destruction. In its place, an unnatural equilibrium has taken root in which the morbidly obese are force-fed the economic lifeblood diverted from vibrant upstarts. The unsustainable is artificially sustained, while the engines of economic potential are starved of oxygen. This misallocation of resources has spread like gasoline-fueled kudzu, choking off productivity growth and suffocating the traditional pathways to upward mobility that made America the shining city on a hill. 4 generations of striving immigrants. My own ancestors braved the perilous journey from India's humble villages to these bountiful shores in pursuit of the American dream, the ideal of merit-based upward mobility rewarding hard work and perseverance regardless of starting points. Yet today's increasingly ossified economic landscape is extinguishing the flickering flames of opportunity that beckoned them here. The facts are as dire as they are unmistakable. Social mobility in the United States now lags virtually every other developed nation, a searing repudiation of our national identity as a fluid class-transcending meritocracy. For the first time in recorded history, a majority of Americans lack confidence their children will experience the prosperity of the previous generation. This crisis of hope and promise is the poisoned fruit of decades of economic policy untethered from the core capitalist tenets of risk and reward. By decoupling outcomes from effort, the safety blanket meant to catch the downtrodden has ballooned into a permanent income transfer supporting a burgeoning class of despondent and purposeless citizens. The creeping putrescence has seeped beyond regional clusters to corrode entire communities, evaporating the cultural preconditions of economic mobility. The social capital accumulated through generations of communal industry and perseverance has steadily drained away as wealthier residents flee the degenerating milieu. In a capitalist system aligned with its governing principles, such vicious cycles of community decline would be natural corrections culling unsustainable enterprises and repurposing stranded assets into fresh wellsprings of value creation. But under the prevailing doctrine of privatized profits and socialized risks, even the most benighted locales subsist in perpetuity on government life support rather than being pruned for revitalization. The personal toll is most wrenching among the working-class inheritors of the American dream deferred. Where industriousness and prudence were once reliable avenues to middle-class respectability, the post-crisis era has heaped indignities upon those striving for self-sufficiency. The pernicious dynamic reaches its apotheosis during recessionary periods officially designated as economic emergencies warranting indiscriminate disbursement of public funds. Where once the dislocation of sharp downturns was confined to those most exposed to business cycle vicissitudes, the ad hoc pandemic rescues entailed the unprecedented spectacle of unsolicited relief checks raining down on white-collar professionals securely ensconced in their work-from-home arrangements. This spectacle laid bare a harsh truth. In 21st century America, the economic safety net has metastasized into an indiscriminate hammock underwriting a sprawling dependency class unmoored from any elemental cycles of effort and production. Beyond merely severing the connection between risk and reward, the entitlement state has subverted the elemental dignity intertwined with self-sufficiency. It is a cruel irony that the original architects of the Reagan Revolution marketed their agenda as a working-class bulwark against the corruption and inefficiency of centralized bureaucracies. Yet the ensuing 4 decades have habituated even the self-professed libertarians to a socialized risk regime more antithetical to the principles of free enterprise than the 1970s-era afflictions it was intended to remedy.